Your credit score is not measuring your financial health. It is measuring how profitable you are to banks. And the difference between those two things is costing the average person over $170,000 in their lifetime. Here is exactly how the system was designed and why nobody tells you this. Let me tell you about the most surveilled number in your financial life. A number that determines whether you can rent an apartment, buy a car, get a mortgage, or sometimes even get a job. A number that follows you everywhere, that can be damaged by a single missed payment, that takes years to build and months to destroy. A number that an entire industry has convinced you represents your financial health. It does not. Your credit score is not a measure of how financially healthy you are. It is not a measure of how much money you have, how well you save, or how close you are to building real wealth. It is a measure of one thing and one thing only: how profitable you are to lenders. And the moment you understand that distinction, everything about the credit system starts to look very different. By the end of this video, you are going to understand exactly how the credit score system was built, who built it, why they built it, and most importantly, why a high credit score and actual finance. If you want to understand how money actually works, hit subscribe. New video every Saturday on Bytes. Financial freedom are not just different things, but are sometimes directly opposed to each other. And that last part is the thing the industry has spent billions of dollars making sure you never figure out. Let us start at the beginning, because the credit score, as most people know it today, did not always exist. Before the 1950s, lending decisions were made locally by individual bank managers who knew their customers personally. If you wanted a loan, you walked into your local bank. The manager knew your family, knew your history, knew your reputation in the community, and made a judgment call. It was inefficient, it was subjective, and it was often deeply unfair, particularly to minorities and women who face systematic discrimination regardless of their actual financial situation. Then, in 1956, a mathematician named Bill Fair and an engineer named Earl Isaac founded a company called Fair Isaac Corporation. You probably know it by its acronym, FICO. Their idea was to replace subjective human judgment with an objective mathematical score. Feed enough data about a person's borrowing history into a formula, and the formula would predict the likelihood of that person repaying a loan. It would remove bias, it would standardize lending, it would democratize access to credit, and in some ways it did. The FICO score genuinely opened access to credit for millions of people who had previously been shut out by discriminatory local lending practices. That part is real and worth acknowledging. But here is what also happened. The companies that adopted the FICO system discovered something extremely valuable. A standardized score did not just help them assess risk, it helped them market debt. Because now, instead of asking whether this specific person should get a loan, they could ask something far more powerful. How do we get more people to want a higher score? And how do we design the scoring system so that the behavior required to get a high score is the same behavior that generates maximum profit for lenders? And that is exactly what they did. Let us look at exactly how the FICO score is calculated, because this is where the design becomes impossible to ignore. Your FICO score is made up of 5 components. Payment history is 35% of your score. Amounts owed is 30%. Length of credit history is 15%. Credit mix is 10%. And new credit is 10%. Sounds reasonable on the surface, but look closer at what each component actually rewards. Payment history rewards you for consistently paying back debt. Makes sense. Amounts owed rewards you for keeping your credit utilization low, meaning using less than 30% of your available credit limit. This sounds responsible, but what it actually means is that you need to have open credit accounts that you regularly use and regularly pay off. Length of credit history rewards you for keeping old credit accounts open for as long as possible. Credit mix rewards you for having multiple types of debt simultaneously. Credit cards, auto loans, mortgages, personal loans. The more types of debt you are successfully managing at the same time, the higher your score. And new credit penalizes you for applying for new credit too often. Now read that list again from the perspective of a lender. The The perfect credit score belongs to someone who has been borrowing money for a long time, who maintains multiple simultaneous debt products, who keeps their credit accounts open and active, and who pays consistently enough to never default, but borrows enough to generate ongoing interest revenue. The perfect credit score does not belong to someone who paid cash for everything and never borrowed a cent. That person has no credit history, and therefore a low or non-existent score. The perfect credit score does not belong to someone who paid off all their debts and closed their accounts. Closing accounts shortens your credit history and reduces your available credit, which hurts your score. The perfect credit score does not belong to someone who saved diligently, invested wisely, and built genuine net worth entirely outside the debt system. In other words, the credit scoring system gives its highest rewards to the person who is most deeply and most permanently embedded in the debt ecosystem, not the person who is most financially healthy, the person who is most financially useful to lenders. And here is where it starts to cost you real money, because the pursuit of a high credit score requires behaviors that are directly at odds with building wealth. Meet Marcus. Marcus is 28. He makes $65,000 a year. Marcus has a 750 credit score, and he is proud of it. He has 3 credit cards that he cycles spending through to maintain his utilization ratio below 30%. He has a car loan that he could have paid off early, but his financial advisor told him paying it off would hurt his credit mix. He keeps his oldest credit card open even though he does not use it because closing it would shorten his credit history. He checks his score regularly and makes financial decisions based on what will help or hurt his number. Marcus is doing everything the credit system rewards, and Marcus is also doing something else. Marcus is keeping money in circulation through debt products instead of redirecting it into assets. The car loan he is maintaining to protect his credit mix costs him $340 a month in payments and interest. Over the remaining 3 years of that loan, that is $12,240 that will go to the lender instead of to Marcus's investment account. If Marcus had invested that $340 a month in a low-cost index fund for those 3 years at a 7% average return, he would have approximately $13,800 at the end. Instead, he has a slightly better credit mix in a lender who collected $12,240 from him. The credit score did not make Marcus wealthier, it made Marcus more expensive to maintain. And here is the historical parallel that makes all of this click into place. Because the credit scoring system did not emerge in a vacuum, it emerged alongside the deliberate expansion of consumer credit in post-war America. In the 1950s and 1960s, as the American middle class grew and wages rose, corporations faced a problem. People were saving more than they were spending. And a saving consumer is a much less profitable consumer than a borrowing one. The solution was not to make products cheaper. The solution was to make borrowing easier, more normalized, and eventually so deeply embedded in everyday life that opting out of the debt system felt financially irresponsible. The credit card industry launched in 1958 with the Bank AmeriCard, which later became Visa. The standardized credit score followed. Then came the marketing of credit as a lifestyle tool rather than an emergency resource. Then came the normalization of carrying a balance as a sign of financial activity rather than financial strain. And at every step, the messaging was the same. A good credit score means you are responsible. A high credit score means you are financially healthy. Build your credit, protect your credit, live your life in a way that keeps your credit score high. What the messaging never said is that every behavior required to keep your credit score high is also a behavior that keeps you as an active participant in the debt economy. That is not a coincidence. That is the design. So what does this actually mean for you practically? Here is the short version. First, understand what your credit score actually is. It is a tool for accessing debt cheaply. That is it. It is not a report card. It is not a measure of financial health. It is a price tag on borrowing. If you need to borrow money, a high credit score means you borrow at lower interest rates. That is genuinely useful, but it is useful the way a good deal on a product you do not need is useful. The best deal is still a purchase. Second, stop making financial decisions based on their impact on your credit score. Paying off debt early is almost always the right financial decision, even if it hurts your credit mix. Closing an account you do not use is fine even if it shortens your credit history. Your net worth is a far more important number than your credit score, and the two are often in direct tension. Third, the goal is not a high credit score. The goal is a high net worth. Those are different games with different rules. The credit score game rewards ongoing participation in the debt system. The net worth game rewards accumulating assets that generate returns. You cannot fully optimize for both at the same time. Decide which game you are actually playing. Fourth, if you do need credit, and most people will at some point for a mortgage or similar large purchase, then yes, manage your score strategically for that specific purpose. But treat it as a temporary tool for a specific transaction, not as a permanent lifestyle to optimize around. And here is the uncomfortable truth that ties all of this together. The credit score system is not evil. It is not a conspiracy. It is a product that was designed by companies with specific profit motives, and those profit motives shape the design in ways that benefit lenders more than borrowers. That is not surprising. That is just how products work. What is surprising is how successfully the industry convinced an entire society that the metric designed to measure your value to lenders is the same thing as a measure of your financial worth as a person. Your credit score tells lenders how profitable you are to them. It tells you almost nothing about how financially free you are or how close you are to building real wealth. And confusing those two things is one of the most expensive mistakes the middle class makes. So here is where I want to know where you land. Option A, you think the credit score system is a reasonable and necessary tool, and the problems with it are overstated. Option B, you think the system is deliberately designed to keep people embedded in debt, and the damage to wealth building is real and significant. Option C, you think the truth is somewhere in the middle, and the credit score is a useful tool that just gets misused. Drop your answer in the comments, because this one tends to split people right down the middle. Because here is the thing about numbers that follow you everywhere. They shape your behavior whether you realize it or not. And when the number was designed by the people who profit from your debt, it is worth asking whose interests you are actually serving when you spend your financial life trying to make it go up. Half Bytes. Full picture.